I am wearing green today. You wanna know why? It is because I am talking about a serious tax saving, greenback saving strategy when it comes to your required minimum distributions, otherwise known as RMDs. So today what I'm going to do is I'm going to show you a side-by-side scenario of someone who makes contributions to charity directly from their IRA versus someone who takes their RMD from their IRA and then turns around and writes a check and makes a traditional, contribution to charity. My name's Ashley Micciche. I'm the CEO of True North Retirement Advisors, where we specialize in retirement and exit planning for business owners. So one of the key ways to keep your income lower once you reach age 70 and a half and you have to start taking those mandatory distributions from your IRA, otherwise known as RMDs, is by taking those RMDs and instead of taking that money directly out of your IRA account where you have to report it as income, you can actually set it up so that those RMDs go directly to a charity of your choosing instead. It's called a qualified charitable distribution. Before we jump in here and go over this case study, I want to clarify a few technical pieces about this rule that are really important to keep in mind. Number one is that you must be 70 and a half to take advantage of this rule. The second rule, and this is really important, these QCDs, qualified charitable distributions, can only come from one of two places: an inherited IRA or a traditional IRA. The maximum amount that you can take out of your IRA and send directly to a charity is $100,000 per person per year. So if you're married, you and your spouse both have IRA accounts and you each want to take $100,000 out of your IRA and $100,000 out of your spouse's IRA, you can do that. You must take the distribution directly from your IRA and set it up so that that money goes directly from your IRA to the qualified charity. So what you're seeing on your screen right now is an illustration of two different scenarios. So I'm going to assume that in this scenario, you are 72 years old, you are still working, you're a business owner, you're still active in your business, and you have wage income of $115,000 that year. The far left column with the numbers in it, you can see that's where you take your RMD. Basically what this means is that you are going to take your mandatory distribution from your IRA that year and not take advantage of the QCD. In the column right next to it where it says make a QCD, that's where you are taking advantage of that qualified charitable distribution rule. All right, so we see in both scenarios there, we have wage income of $115,000. You have interest and dividend income of $50,000 from taxable accounts. You have Social Security, taxable Social Security of about $34,000. And here's where it starts to get where the paths diverge. Okay, other income. In the in the left-hand side, you can see that the other income is $18,000. That is your required minimum distribution for this year, $18,000. Right next to it, you can see that the other income is zero, because in the second scenario where you're making a QCD, you are not actually reporting the RMD as other income because you have no income to report there. It's going to charity. You're still taking the $18,000 out, but by sending that money directly to the charity, it doesn't get reported in other income. So when you add all those up, we get a total income when you take your RMD of $217,000 versus $99,000, a difference of $18,000, which is the RMD amount. And we have 0 adjustments for an adjusted gross income of the same figure as the total income above. Moving down, we have no personal exemptions in either scenario. Then we move on to the itemized deductions. So to keep this nice, clean, and easy, I'm going to assume that you are making charitable contributions of $18,000. And then you can see in the column next to that, the charitable contributions is 0. You actually don't have anything to report in this area on this particular line item, even though you did make contributions, but because you did it through your required minimum distribution, it doesn't show up as a line item here. And then in both scenarios, we've got property and state taxes of approximately $10,000 that we're reporting right there, for total itemized deductions of $28,000 in the one scenario where you're taking your RMD, and $10,000 in the other scenario where you're making a qualified charitable distribution. The standard deduction in this case for someone who's 72 years old is $26,600. This is with the new 2018 tax law that went into effect. And so basically what this means is that if your itemized deductions are going to be below $26,600, you're just going to take the standardized deductions. If they're above that, you're actually going to itemize. So because you've made that big charitable contribution and you have quite a bit, $28,000 in itemized deductions, that's what you're going to report as your total deductions from AGI. In the second scenario where you're making that qualified charitable distribution, you're just going to actually take the standardized deduction there of $26,600 and not itemize. Next row, where we're showing total taxable income after deductions, is $189,000 or the lower taxable income of $172,400 for a total taxable income difference of $16,600. Below that, we see schedule or table tax. That's the federal tax. When you look at what your tax bracket is, that's the amount of taxes that you're paying. Interestingly enough, we also have taxes. The taxes are different on the gains that you pay as well. But once you consider what your standard taxes would be, and then take into account the difference in capital gains tax, we have total federal taxes owed of $31,359 in the scenario where you took your RMD, and $27,707 in the scenario where you made that qualified charitable distribution instead, for a total difference of $3,652. One final point with this is we're located in Oregon. I'm assuming that there's state income tax here as well of about $12,866, but that's not changing, as you can see, in either scenario. Talk to your tax advisor, see if this makes sense for you. If you're working with a competent CPA, they can usually give you a pretty good, ballpark idea of whether or not this strategy is going to make sense for you. In an ideal world, they're actually being proactive and looking at your tax situation and coming to you with these ideas versus you going to them. And your financial advisor should be doing the same thing as well. Thanks again for watching. My name is Ashley Micciche. Did you find this valuable? If so, give this video a thumbs up. Like this video, comment below and subscribe to our channel. This is one of an entire series we're doing on RMDs. If you have questions about your unique situation, post a comment below, because chances are if you have a question, other people do too, and they can benefit from hearing your question and hearing the answer. If you would like to remain anonymous, you can also schedule a free RMD strategy call. So if you click the link below this video, you'll have access to our calendar and you can schedule a time that is convenient for you. Thanks again for watching, and I'll see you next time. QCD, RMD, QCD. RMDs?
That was so bad. RMD?